Cliff,
Hey, Dan, how are you?
fantastic. Thanks for joining.
Thank you. Thank you.
So I guess we may as well get right into it. I notice it's just after 8 o'clock. First thing I'll do is I'm just going to welcome everybody to our monthly investment seminar. We seem to be having a lot of good luck with these. It just seems like there's a lot of people interested, not so much in real estate, but on the investment side as well. And I can't believe how many people want to own more than one house or have an investment and realize that real estate is actually a really good investment and has stood the test of time. I mean, I just look at my database and I've got well over 16,000 people that we've dealt with over the last 30 years that we keep in touch with on a regular basis. And, we found out very quickly that doing the one deal was just the beginning. It was just the tip of the iceberg. We'd ask the questions and find out they had a lot of equity that wasn't being used appropriately. They had a bad experience in the stock market. And I guess most people want to have that second or third property, because I keep using this story about 20 years ago. I'd sell a house in, one section of Oakville or Burlington, and it'd sell for 300,000. And now I'm going in selling the same house to different people, and it's going for like 1.4 million. So the return is incredible. And what's even more so is the fact that now that we're getting through, the essence of COVID, real estate was unaffected. And that speaks volumes to me. The fact that real estate, after 5 months of a flat market, actually went up 1%. So to me, that makes me really believe in my product. And just that's why we're talking about investing. So every month we have a slightly different slant, slightly different twist to this. And so that's why I have you here. Everybody that's online right now, I'd like to introduce you to Cliff Fraser. And Cliff is the Chief Business Development Officer with Equiton. And he has a wealth of knowledge. He's been in the business for a long time, and the company is quite impressive. I mean, some of the stats I know. I mean, the fact that you manage 10 billion in assets, like that's a lot. The fact that you manage 10,000 apartments, you have you've developed over 1 million square feet of space. And, so obviously having you here is fantastic. I really appreciate that. I'm going to jump right in because
Sure.
I know you've got a deck that you can go through tonight,
Sure.
based on what you want to say, but there's a lot of people that I deal with that don't understand your side of the market. I'm going to throw a question at you. Let's talk maybe the difference between public versus private markets. Maybe I'll just start right there with a question to you.
Sure. That's perfect. And that's kind of the starting point or the building blocks, if you will, to understand what we do at Equiton and kind of how it's different. So maybe I'll throw up the deck here and we'll crawl through some of these pages. I promise I won't take 3-4 hours like I usually do. So hopefully, can you see that, Dan?
Yes, perfect.
Okay, perfect. So, we like to say at Equiton, we see what others don't when it comes to real estate. And so I'm going to kind of just take you through a little bit of our story and get into exactly Dan's question about the difference between publics and private. So here's the secret sauce right here. So take notes really quickly. Okay, great, we're done. So yes, Dan was excellent in covering exactly what we've done as an executive team over the last collectively, we've got 100 years of experience in real estate. That's all we do. Many of us, that's, our only career path has been in real estate. So it does give us a very unique perspective when it comes to acquiring real estate and managing real estate. So the private capital markets, as Dan asked. So this is something that not many people are aware of. And quite frankly, you shouldn't feel too bad about that, because up until 2016, most people couldn't get access to the private capital market. So, typically what I like to take people through is the public markets and kind of remind them of what's gone on in the public markets. And this is kind of your typical investment options at any given time is, you ride this roller coaster, and whether you like roller coasters or not, if you're looking to do something for your retirement, by and large, these are the options that you've had. You either get involved in the equity market and in the stock market, or you get involved in fixed income or some kind of GIC. And as you can see, when you look at the returns, you've either got that undulating roller coaster, which may make some of you sick, or you've got something where you're not making a heck of a lot of money. And I believe that the US Federal Reserve came out with a statement today that they're not planning on moving rates until 2023. So if you're looking for some money to make, the stock market's probably not going to be it. And certainly these kinds of fixed income assets aren't going to be it. So if you don't want to be eating cat food in your retirement, what have you been taught to do? You know, you've been taught to diversify, and traditionally, in the public markets, your diversification is through investing in different kinds of asset classes or different kinds of asset types. So whether that be, you know, utilities or consumer packaged goods or communication, what have you. But really, you're not truly diversified. You're exposed 100% to the public market. And so now you have access to the private market, and that can add another dimension to your investment portfolio. So what exactly are the private markets? So the private markets are an investment in a company or some kind of security. The only difference is you aren't able to sell those instruments or sell those securities at a given notice. You can't call your broker and say sell, sell, sell. You can't call your broker and say buy, buy, buy. They're not traded on the stock market. So what happens is you don't have liquidity just like you would in buying a stock or a bond. But what happens is you don't actually get that same kind of roller coaster ride because you're willing to give up some of that liquidity. So you get something that is certainly more, can be more conservative, can be less volatile, and can actually, you know, potentially earn you more money. Up until 2016, most people could not access the private capital markets. It was really rich folks. You had to have a certain level of income, which I believe here is. I don't need to think off the top of my head. So these are the kinds of categories that have been brought into Ontario in 2016. So before 2016, on the, I guess on my left here, the accredited investor is really the only kind of investor that could invest in privates. And as you can see, very high income threshold, whether that be individual or household income, and then also very high requirements when it comes to net financial assets and net worth. In 2016, the eligible investor category came to be. That's anyone that makes more than $75,000 on their own, more than $125,000 as a household, or has more than $400,000 in net worth. So if you've got one of those places in Oakville that Dan alluded to, you've probably got more than enough equity to qualify as an eligible investor now. So you can add privates to your investment portfolio in a way that you were never able to. Now, why haven't you heard of this before? Well, because RBC and Bank of Montreal, they don't offer these kinds of investments to you. So, you know, as a shrewd investor and as a shrewd investor in real estate, you have to go hunting for these. And that's why I'm here and helping Dan and his team educate the audience on what privates are and how you can get access to them. So what we like to talk about is the smart money, you know, whereas I'm the dumb money. The smart money is the pension plans, the big life cos, the big institutions. They have figured out the importance of the private investment or alternatives many, many years ago. So if you look at 1995, if you can cast your mind back, that's when I had more hair and a smaller nose. The smart money invested just like you do, 60-40 equities, fixed income. But if you look at what's happened over the last 30 plus years, their reliance on equities and their reliance on fixed income to, you know, generate returns for their stakeholders has dwindled significantly, whereas now alternatives, and real estate is considered an alternative, 39% of their portfolio in 2019 has been alternative. So that could be, you know, infrastructure, private lending, private debt, that kind of thing. Real estate, that's what falls into that alternatives category. So why aren't you as an individual investor investing the same way that some of Canada's biggest pension plans are investing? It's because you've never been given the opportunity to do so before. So I like this slide. I don't mean to disparage anybody that works at a bank branch, but typically if you walk into the bank branch or you have a bank branch advisor that is helping you with your investments, this is what you get. You get the first three columns. You're either a conservative investor, you're either a balanced investor, or some kind of growth investor. But look at the mix of alternatives, equities, and bonds. They don't really change that much across those three. But again, if we look at what the top 10 Canadian pension plans are doing, that's the kind of goal. That's what you want to try to aim for if you can and if it's suitable for you. So the old paradigm is you get your diversification by investing in different sectors in the public markets. Whereas the new paradigm for true diversification, you should you should add privates to your investment portfolio.
Now, Cliff, that last pie graph blows me away because real estate was only 4%.
Back in, yes, of that slice, that's right. And that would only be a public real estate investment, not a private real estate investment. And so public real estate investment, so that's a very shrewd point, Dan, thank you. Public real estate investments fall into this category, but they move just like the stock market does. And I've got a slide coming up that demonstrates that pretty clearly. I think it will surprise a lot of people. So real estate, I don't want to belabor this, why do people invest in real estate? Real estate, you have to think of real estate in different categories. These are the kind of 5 broad categories that we at Equiton consider, the kind of most important or the most recognizable. There are other little slivers and slices, but for us, multifamily, commercial, industrial development, and lending. And most of the media coverage, prior to COVID, when everybody started talking about rent, but most of the media coverage has just been on single family homes and condos. And really, they don't price or trade the same way as a multi-purpose or a multi-residential, commercial, industrial, or development property trade. So they're not valued the same way. They're largely valued on emotion and the relative value of other homes or condos in your area. But these kinds of investments don't price that way, and they're not bought and sold that way. So they behave differently. They have different risks. They have different rewards, and they also have different cash flows. So it's important when you're looking at real estate, especially in the private space, that you understand exactly what focus you want to have. You can have a little bit of each, or you can find some kind of balanced approach to it, or you can just pick one slice that you want to concentrate on, one that you're comfortable with. Here, I won't beat this up, but it's a great way to generate income. It's a hard asset. We all know this. It's actually inflation protection. It is a great use of leverage as well. You don't always have to invest in real estate with your own money. A couple of things I just want to hit at here is, Southern Ontario, the center of the universe. What is really driving demand here? It's really land scarcity. Demographics and population increase are a big component of that, and kind of urban sprawl. People are leaving the GTA and moving further and further out. New home affordability, work life, work, live, and play, and working from home. But it's really land scarcity. So here's a shot of Southern Ontario. So obviously where we are on the map, but really we've got the lake on one side and we've got the kind of artificial green belt on the other, and that kind of white line, which is the urban boundary. So you can't actually develop beyond that urban boundary. Now, lots of people will say that, oh, it's because of the environmental reasons, and we all want to keep Greta Thunberg happy, but quite frankly, it's more basic than that. The reason why we can't sprawl and we can't develop into the green belt is the actual financial economics of it. For a developer, to build way up in the north, how are they going to do that if the city doesn't have water, sewer, hydro, water treatment? If none of that infrastructure is there, the developer doesn't really want to pay for it. The city doesn't want to pay for it, so it costs too much. So that's why you're seeing, certainly in Southern Ontario, Greater Golden Horseshoe, a lot more intensification, a lot more condos. 10 years ago, if you said to me that we're going to be 3-4 towers near the GO train station in Burlington, I would have said, you're crazy. It's never going to happen. But there it is. So this is what's driving, real estate demand is we are constrained. There is more demand than there is supply. What little supply there is very expensive. It's expensive to buy the land. It's expensive to develop the land. And that's what's driving up the pricing of real estate. Go ahead, Dan. It looks like you're going to ask me something.
I was just going to say that map really kind of gives you the perspective that you need, because for all intents and purposes, we're very landlocked. I mean,
correct.
You can't go southeast because that's the lake. And obviously we've got, the greenlands, all the surrounding area that can't be touched at this point in time. So it's just going to create more and more density where we are and, cause upward pressure on pricing.
You got it. That's exactly it. So I don't want to, beat this to death here. Development is really, for those that aren't really familiar or want to dip their toe in it. Development is the process of converting raw land into saleable real estate. So that can be residential, commercial, industrial, whatever. It's essentially real estate manufacturing. So it can be a lengthy and potentially complicated process because there are lots of moving parts in it. But one thing to remember, if anybody says to you that they've got a development that will pay you every single month or pay you every single year some kind of return, I highly suggest that you run, because developments don't pay anything until the development is done, until the keys of the condo are handed over to the person that is moving in. There's no money to be made. But if you're willing to accept that risk and accept a little bit of that uncertainty, you can do very, very well in development if the development partner that you're working with knows what he or she is doing. Lending, again, same sort of thing. You want to really understand what you're lending, because not all lending vehicles are created equally. Not all of them do the same thing, and not all of them provide you with the same kind of protection. So you really got to get into the weeds here. You will get a monthly cash flow, normally it's at some kind of fixed rate of return over a fixed period of time, but there is risk associated with that depending on how much you are lending to a borrower. So it's important to understand what those are. But again, you can make you can do really well on lending, but just know that after a certain period of time, if you get all your capital back, you've got to now figure out something else to do with that capital, because you've got to spend it again. Mm-hmm. So here's what I really wanted to dig into is toilets and tenants, what we affectionately call at Equiton. So apartments. Apartments are, I hate to say it's almost pandemic proof. Maybe that's a bit of an overstatement, but even during the the last 6-8 months, privately held apartments have done fairly well across Ontario. Certain parts of Canada have had their issues, which I'll get into in a moment. But why would someone want to invest in apartment? Well, it's essential real estate. Everybody talks about essential workers and essential this and essential that. I believe that apartments are essential real estate because if you go back to whatever it is, grade 9 science maybe, or wherever, if you think of Maslow's hierarchy of needs, right? Food and shelter. We are in the shelter business. I know it's not grade 9 science. I fluffed that one. But anyways, everybody needs a place to live. It's a product of necessity. Renting has become more of an acceptable lifestyle because it is difficult for many people, many new Canadians, to get on the property ladder. So, but the most important thing to realize about apartments, it's as much as it's real estate, it's a business, and it is bought and sold based on business fundamentals. And right now, if we go back to that map of Southern Ontario, it is cheaper to buy existing apartments than it is to build new ones in most markets. And the historical performance of apartments have really outpaced other investment categories. So here's an ugly chart, but what I want to demonstrate for you here is that the private apartment index, which is tracked by MSCI, has tracked the performance of private apartments since 1984. So the one thing I want you to realize on this line is it's never gone down. So even during all these financial crises, the private apartment index in Canada has never had a negative year of returns in 35 plus years.
Are you concerned at all about real estate values and apartments performances in light of COVID?
In the short term, no. Real estate is a get rich, and especially apartments is a get rich slow investment. So if real estate values are flat right now, or if not real estate, but if apartment values are flat right now, does it matter if you're not in the market to sell? Not really, because next year or the year after, when values start to rise again, if you are running your building prudently, you're collecting rent, you've got really good tenancy, you're going to get that value. It's just going to be delayed. I don't see any, what we focus on here is a permanent decrease, a permanent decrease in tenancy, or a permanent increase in delinquency, a permanent impairment of value. And we don't expect that here, because the fundamentals of apartments in Ontario haven't changed. There is way more demand than there is supply. And if you're investing in the right cities, which I'll get into how you invest in the right cities, you're not going to feel it. It's going to insulate you from the shock that we're going through right now. So another complicated chart, but what I want you to focus on is on the far right, on the far left here is that orange bar. So that is the performance of the private apartment index since, how far do we go back here? Since 1988. So the difference between that little orange bar and all the other ones is the average return over that 30 plus years and the highest and the lowest return. So this is kind of illustrating the volatility, how much apartments go up and down over that time period. So what do you notice? Well, one is that of all real estate categories, it has the best average return over that period, and it's never had a negative year. And when you look at Canadian equities, overall, you've had a 9.8% return, but that's if you stuck in it for the whole time. If you decided to panic, or if your broker panicked and you got out, and then you got back in, and then you got out, and then you got back in, that's what you get when you invest publicly. You get that volatility. So yes, you may have earned 45.9% at one point, but you may have also lost 31.4. And how long does it take you to get back? What happened in 2008 is people that were close to retirement, they lost 30% of their portfolio. Well, I can't afford to retire now. So, you know, investing privately in real estate can help insulate you from a lot of this noise.
Well,
so
that's what happened at the beginning of this year. As soon as we went into COVID territory in, probably beginning of March, stock market went down overnight. And, obviously, since it's so easy to, get in and get out of it just, people jump ship and then they buy back in when the time isn't right. So then there goes their return.
It's like you read ahead, Dan, because this is exactly what's happened here. So we've got Q1 and Q2 of 2020 illustrated here. So as you can see, this whole chart going back to 2005, I'll give 100 internet points to, well, I guess I can't hear if someone's going to guess the right answer, but you're going to get 100 internet points if you got this right. The public REITs and the Canadian equity markets move in lockstep. When the stock market goes down, public REITs go down. So in 2008, public REITs fell further than the Toronto Stock Exchange. They were down 38%, whereas the stock exchange was down 31%. Private apartment index up 6.5% during that same period. Wow. Fast forward to 2020, as you just said, in March, everybody pooped the bed proverbially. Stock market was down, public REITs were down, private apartment index up. And then cumulatively, as of the end of Q2, stock market made a little bit of a rebound. So not quite back to flat, not back to zero, but still a little bit under. But advisors will say to you, oh, it's pretty close to zero kind of thing, right? But public REITs didn't make the rebound. And the private apartment index up again. So it's a very, very, stable and conservative investment that if you stick with it for the long haul, it takes out all the noise.
Well, that's what we've always said about real estate, buy and hold.
Buy and hold. And this is, this is why we say apartments work harder for you, because you get income and cash flow every single month from the tenant base. They are also effectively buying the building for you because you're using their rent that you collect to pay down the mortgage, because we should use leverage, and the building value or the real estate value will go up over time. So that's how you get your return from apartments. So this is why we like apartments. And when you're thinking of investing, in private markets and you want to get into real estate, apartments is probably the best place to start, the best foundation, if you'll excuse the developer pun. So it's important to buy it right. So I alluded to this earlier. It's really about, yes, it's location, but it is all about due diligence, because you can make a mistake. So you have to buy real estate at the right price, whether it's apartments or whether it's condos. You've got to buy it at the right price. And it's important to buy it at the right price in the right location. So when we look at a target building to go after, we make sure we understand the city, the market, the client base, the demographics, who the employers are, because I don't want to worry about trying to steal tenants from my competition's building. I want there to be enough inflow and enough demand in that community that if a pandemic happens, I'm still going to have a solid, sound renter base. So you really do have to turn over every single rock, because you don't want to overpay. You'd never want to overpay. So one of the things that we've been able to do, and even during the pandemic, we have been able to buy assets, surprisingly, where our competition hasn't. It's because we do work with the broker network, but during the lockdown, all those listings dried up. But what we have done over the last 3 or 4 years is develop a property pipeline so that we always have product that we can look at. So right now it's called Property Track, and it's our proprietary database. We're tracking about 4,000 income producing assets. That's just in Southern Ontario. So call it from Kingston to Windsor, the 401 corridor. And what do? Well, we have the name, address, and phone number of those owners of those buildings. So all the privately held apartment buildings that are greater than 40 doors, and we go door knocking. So it allows us to develop relationships with these owners, even if they're not ready to sell. We're still there. We go and we see them, we listen to them talk about their cats and their psoriasis and their grandkids, and hopefully at some point, because it usually happens in the apartment space, is they are at some point down the line ready to sell. And because they have a relationship with us, and you know this, Dan, this is a relationship business. If you're comfortable with who you're working with, that's the first person you're going to call. If someone is comfortable with you, Dan, and your team, the way you've helped them in the past, they're going to recommend you, or they're going to call you the next time they want to sell. It's the same thing with trying to buy apartments. So apartments are an easy concept, right? You got tenants, pay the rent, collect the rent, pay your expenses, cash at the end, but it requires active day-to-day management. You really do have to roll your sleeves up and get dirty. Most of the apartments in Southern Ontario are privately held, mom and pops and small partnerships. And they're not professional managers. Sometimes these buildings are undermanaged. And so those are the kinds of jewels that we look for, where there's a lot of low-hanging fruit, there's money left on the table. I'll give you an example. We purchased a building in Kingston back in 2018. For those of you that don't know, Kingston at the time was the hottest market in Ontario, if not the hottest market in the country. Ultra low vacancy. So we had a gentleman that we had tried to do a deal with back in 2015. He lived in Woodbridge. He wasn't getting out to Kingston very often, and he was getting old. Unfortunately for him, there was a health crisis, and he finally decided that he had to sell. So we couldn't do a deal in 2015, and he came back to us in the summer of 2017 and said, let's try and do a deal, because again, I like you. I like how you dealt with us 3 years ago. So as we were going through the due diligence, this is what we found. In the hottest market in the country, and this wasn't his only building, so he was, call it a pseudo-professional apartment operator. He was paying the landlord $90,000 a year to run that building, plus free room and board. Now, for a building of that size, you shouldn't be paying more than $40,000 or $50,000. So he's already paying way too much in salary. That landlord decided to take it upon himself to take a one-bedroom unit on the main floor in the hottest market in the country and convert it into his own storage locker. They were also allowed to charge for parking. 112 spots times $40 a month times 12 months a year. You can do the math. I'm not that smart. They weren't charging for parking. It was in the lease agreement. They weren't charging for parking. They were allowed to charge for hydro and air conditioner unit rentals in the summer. They weren't. They were giving them away for free. And the best part, the icing on the cake, on this already rotten cake, is that the owner of the building got into bed with a local cable internet provider to provide free internet to the entire building on his dime at a cost of about $30,000 a year. So, if you're buying at a 5 cap and you look, and that's over and above rents being under market and expenses being too high. So, if you're buying at a 5 cap and you're able to eke out, $200,000 in value because expenses are too high or revenues are too low, that's $1 million in value at a 5 cap. So those are the kinds of deals that we look for and that we've been able to, achieve. So it's not just about rent, increasing rent. That's important. You want to increase rent on turnover, but it's also those non-rent revenue items and those expense items that you can chip away at. So whether it be, low flow toilets, sub-metering the building, LED lighting, that kind of thing. It's a game of pennies, but those pennies add up month over month, year over year.
So let's talk about cap rates for a minute. And
sure.
What do they mean these days?
So to me, and to many of the people in the hallowed halls here at Equiton, going in cap rate doesn't matter. So that's a controversial statement. It does kind of get a lot of people to, their eyebrows kind of prick up. And the reason why is you can have Look, cap rate is a point in time metric on a particular building. It is not like an earnings per share calculation or a price earnings ratio that you can use with a stock or a bond. It's not really transferable from one building to another. It's not even transferable from, a building on one side of the street to a building on the other side of the street. I'll give you an example. We purchased a building in Brantford a few years back. It has a sister building across an alleyway, right? Or not even an alleyway, it's a breezeway. Both buildings built at the exact same time, aesthetically exactly the same number of units, everything's the same. Different owners. When you look, oh, I lost the lights, there we go. When you look at the buildings, you'd think, okay, if their cash flow is the same and they're asking the same price, then the cap rate's the same, right? And whichever one has the better cap rate, that's the one I should buy. Well, when we looked into it, the building that we didn't buy across the street, the owner of the building didn't own the land. They were in year 80 of a 99-year land lease with Manulife. So if you went and looked at those two buildings and were making a decision just strictly based on cap rate, and one had a better cap rate than the other, and you didn't know about the land lease, bet you got screwed on that deal. So it's really important to dig into every little piece, because sometimes you get a cap rate based on normalized income. My kids call these rabbit ears, normalized income. And that may not necessarily be income that you can achieve right away, or maybe you do achieve it right away, but maybe you can do better. So if we bought Kingston, the building with the free internet, just based on cap rate, we may have said, or we may have thought, well, it's okay at 5.5 cap or whatever it turned out to be. But peeling back the layers of the onion, you realize there's probably another 2.5 points there. So maybe it's actually worth 7.5 cap based on the price that I paid. The other thing is
that what you're looking for these days, like between 5 and 6% cap rates?
That's tough to find these days. Unlevered, you're looking at, again, depends on where. Secondary, markets kind of further outside of the GTA, you do get better value. So cap rates are a little bit better. The closer you are to Toronto, you're looking at, 2.5 and 2 3/4 and 3% cap rate, going in cap rates that are kind of unlevered. But one thing to remember too, so the cap rate calculation for people that don't know or aren't familiar with it, it's the net operating income divided by the price or the appraised value of the building. That's what gives you the cap rate. So if you've got $500,000 in income and it's $10 million to buy the building, that's your 5 cap, okay, or 5%. But those don't always move in tandem. Sometimes there can be a lag. Sometimes I can accelerate month over month. I can accelerate the net operating income, because if my units are turning over and I'm getting more money for my units, so the net operating income is increasing, but I don't go and get the building valued every single day. So the value is still, what I paid for it a month ago. Yeah. But I can increase the NOI immediately. Like I'll keep going back to the Kingston example. The moment we took over the keys, we got rid of that super, we brought another unit back online, started charging for parking. So now you've increased the NOI immediately, but you're not going to go and get that building appraised again to change the denominator, to change the price. So it's, is it important? It's like if I said to you, Dan, what's the average price of a house in Oakville? And you'll say to me, it's $1 million or whatever, right? So I say, oh, great. So on Lakeshore at Trafalgar, I can get a house for $1 million? Well, no, maybe you could. You may not want to live there, it may be derelict, but so it's like that with a cap rate. It's like, oh, if this is a 5 cap rate, good. Well, maybe, but maybe not.
Now I'm getting some questions here.
Sure.
And I've got one question here. Am I locked into your investments, and what if I need the money?
Mm-hmm. So that's a great question. So, there is no formal lock-in. It's not like a development where you invest some money and you got to wait for the development to end. You really don't have the ability to get access to the funds. So what we suggest for people is, if because there are life events that happen where people need to get at their money. What we're finding is that most of our investors are investing through their registered plan, their RSP, TFSA, LIRA, that kind of thing. So it's not something that they actually need to access anytime soon. But having said that, let's say that you do. Depending on what we really suggest is you have at least a 3 to 5 year hold in mind. You know, during the first 5 years of the investment, there are some early redemption fees. So you would have to pay those to get out, but you are able to get access to your money on a monthly basis.
So what's the typical hold time?
I mean, we launched the fund in 2016. We haven't actually had a lot of redemptions over that time period, but most people, as I said, they're putting money in with their Lira or their kids' RESP kind of thing. So they have a 5 to 10 year hold in mind. And, at 5 to 10 years, that's when you really, at 5 years, that's when you really start seeing the benefits of holding for a slice of your portfolio, holding these kinds of investments.
Now, in the past, you've also mentioned, obviously, you've got many different types of real estate funds. I know you mentioned to me there's an apartment fund, there's a balance fund.
Yeah.
Can you spend a couple minutes just talking
Yeah,
about
sure. Let me, I'll zip through this. So, on the apartment side of things, we're not really buying buildings that need a ton of capital, that I have to spend millions of dollars to fix the balconies and the staircases and get all the drug dealers out of the building. So these are cash flowing buildings that I like to say, need a little bit of lipstick. They need to be run through the car wash. So we're not spending a whole lot of money on these buildings or these units when we re-rent them, when we turn them over. So as you can see here, this is really just cosmetic kind of thing. So I just wanted to point that out, that it's not, I'm not spending $5-10 million. It's just fresh coat of paint, new handles on the cabinetry, that kind of thing.
Smart.
So here's the apartment fund. So the apartment fund is, targeting these undervalued existing multi-residential apartments and student housing. We don't actually have any student housing in the portfolio, which I am quite glad for right now, given what's going on. I mean, I think there'll be opportunity to buy good student housing, but I want to wait for, whatever the second wave of this is, and maybe wait for, the second semester of post-secondary school before we start looking at student housing again. So what we're looking to do is kind of consolidate that fragmented mom and pop ownership that I talked about, and then actively unlock the value. You know what? These are what most apartment buildings look like in Canada. Yes, in Toronto, you're going to get the 40-story towers that are apartments, and in Montreal and Vancouver, but most look like this, 3-4 story walk up, 7, 8, 10-story buildings.
Are these buildings that you own now? And
these are all buildings that we own now. Top left is Mississauga, bottom left is Markham, top right is London, and bottom right is Brantford. So we've got 19 buildings in the portfolio, 98% leased. We've got 960 doors. We do use leverage, so we do borrow from big banks, but we don't highly lever them. So we're at 51% loan to value in the fund right now. And we do 10-year fixed rate mortgages. The last mortgage that we did on I don't have a picture of the building yet. We just picked up a $33 million building in Guelph, 2.17% for 10-year fixed rate money. So we get money pretty cheap.
Wow.
Pretty cheap. Yeah, so this is the mix of the portfolio across Ontario. So the bulk of it being, on a dollar basis is in the Greater Toronto area. But, I've put the prices up here, and the reason that I want to highlight the prices is that, again, this is essential real estate. This is not luxury. The average rental monthly rent is $1,100 across 960 doors. So, this is not $5,000 a month in Yorkville. It's not geared to income. It's kind of right in that, that meaty part of the rental space. Again, a couple of things here just to highlight is revenue gap to market. So on the left-hand side, the fourth one down, 22.3% across our portfolio. That's how much upside there is when these units turn over. So there's a lot of opportunity to increase the cash flow. So here's Guelph. Paid 33 for it. It was appraised at 33.04. Rents are 11% below market, 99% leased. We bought this at the end of July. Every single building other than one was all buildings have been at or below market. This is Woodbine in the Beaches. Just got to move my pictures here. So we paid 19 and change for this, and it was appraised at 22.1. So ugly outside, I'll grant you. So this one will have a bit of all the units inside have been renoed, but we're going to be working on a beautification program for the outside of this building. Paisley, 47.2 is the current value of this. We bought it at the end of December. Rents are 60% below market. So a lot of upside and a lot of potential in this building. And
so,
then
Clifford, you know, I've got a lot of people I'm working with that have some disposable income. They have equity ready to do investment. So how do we invest with Equiton?
Yeah, so investing with us is fairly straightforward. You know, we'd have to go through that, you know, that qualification process that I talked, you know, way back at the top of the hour, talked about how someone would qualify for as an investor. You know, the targeted return for our apartment fund is 7 to 10%. So that's monthly cash flow as well as the share price of the fund going up over time. And you have to pick whether you want to invest, you know, through what registered plan you want to invest through. The minimum is 10,000. You know, we do pay monthly distributions, as I said, monthly liquidity. Unit prices or the share price is calculated on a monthly basis. You know, if you're investing cash, which some investors do, it's tax deferred for, it's considered return of capital for tax purposes. So it's very tax efficient as well. So, you know, I'll throw up an email for your office where, you know, people can get in touch through you if they're interested in finding out more about what we do. Talked about this, where we're at with the fund, the size, yada, yada, yada. Unit price has been going up. So we've had 52 months of positive returns. Governance is really important in the private space. It's important whether you're looking at us or any other private investment, make sure they have sound governance and oversight. So what we have done is we have a 5-member board. Only 2 are insiders, Jason, my CEO, and Helen, my CFO, and the remaining 3 are independent outsiders. So it's not my brother or Jason's cousin or anything like that. So anything that we do when we're running the fund as the asset manager, we are beholden to those independent members, and we have to demonstrate to them the building that we're buying, you know, there's no conflict of interest. Here's why it makes sense for the portfolio. Here's why it's positive to the portfolio. So we've got really, really strong oversight and governance. You talked about the balance fund. And the only reason I'm rushing now is I want to get to questions that people have. Otherwise, I can keep talking, as you can tell. You know, the balance fund we created a couple of years ago, largely because we were getting the opportunity to invest in a lot more than just apartments. So what we decided to do was come up with the strategy where we can give investors access to more than one real estate category under one roof. So you don't have to go and shop around for it. So the beauty of that is that you get instant diversification. You kind of get to spread the risk out over multiple real estate categories. And you can also smooth out the cash flow. So for instance, in the balance fund, there's kind of 3 parts to it. One is income producing assets that aren't apartments. So industrial, commercial, and mixed use. So you get cash flow from that, as well as the value of that real estate going up. We also invest in kind of large scale commercial lending. So, you know, could be a land loan, that kind of thing. And we also invest in real estate development. But the nice thing is, because we have all 3 in there, you're still collecting cash flow. Remember I said, if you have a development opportunity that says it pays cash flow, you should run away. Well, the developments in this fund won't pay cash flow, but the income producing assets and the lending does. So that's how you get to kind of ring the register with this one, which is a little bit different strategy. So it's a little bit higher risk, has a higher targeted return, 8 to 12% targeted return. So a little bit higher, lower minimum, $5,000 minimum, but can get into it the same way as the apartment fund. So through your RSP or TFSA, we do also have distribution reinvestment options. So what does that mean? Is if you don't need the monthly cash flow for either of these funds, you can reinvest every single month and get a 2% discount. So you get, you know, free shares every month. And that kind of helps with the compounding of your returns. So it's essentially the same sort of setup. If you can put whatever you want in here, whether it be your registered plan or your non-registered plan. There you go.
Very cool.
Yeah. So again, this has got a separate board as well. So I wanted to just highlight that. And so, you know, I think kind of for us, the secret is to help people understand that, you know, they may not truly be diversified, that, you know, maybe you should look at investing the way the smart money has, and you have access to an investment category that, you know, was never available to you before. And, you know, not all real estate's kind of created equal. So it's important to understand the, the ins and outs of the different kinds of real estate that are out there. So hopefully that's helped. Happy to kind of open the floor to questions now.
Well, I've got one here. How are your
Okay.
investments different from your competitors?
So in a few different ways. I mean, I guess it depends on who you consider our competitor. So I will just kind of stick to our competitors in the private space. One is that we are real estate experts first. So we're not bankers, lawyers, doctors that decided to get into, making money in real estate. So I think that gives us a very unique approach. We are always open, whereas some of our competitors aren't always open for new investments. So that's a differentiator. Some of our competitors don't have the tax advantages that we do. They also have, in the apartment space, a lot of our competitors are running larger portfolios, but they've been optimized. So there's not a lot of upside, the way we have upside, because we're buying sub-optimized or unoptimized apartments right now. So there's a lot of growth still available. So there's more opportunity for bigger cash flow and the value of the buildings going up over time. So I think that's quite different as well from us. And our apartment strategy is only an apartment strategy, and it's only an equity investment. So you are investing passively in a growing pool of apartments that you don't have to do any of the hard work. And it's never going to be anything else other than just apartments. We're not going to invest in lending, or we're not going to invest in development through the apartment fund. So if all you want is a discrete, crisp, clean apartment strategy, we're the game in town for that in what I consider to be really economically strong markets, because the biggest risk in apartments, here's a free takeaway for everybody. The biggest risk in apartments is population decline. So if you are in a market that is going to potentially feel a population crunch, you could be at risk, because you could have the sexiest building in the neighborhood, but if no one wants to live there, it doesn't really matter. So you want to be in very diverse cities and towns, economically diverse cities and towns, so that it does insulate you from these kinds of things. Our friends in Alberta are getting a kind of double whammy with pandemic, as well as, oil and gas taking a beating. So that's going to have an impact on people wanting to live there. And, what we're seeing in Ontario is not just immigration, but we're seeing migration, right? So the gentleman that lived in PEI that moved to Fort McMurray to make $300,000 a year driving a dump truck, and when that job goes, he or she's probably not going back to PEI. They're coming back here. So we're seeing a lot of net migration too. So that helps. That helps with rental demand here.
Now, Cliff, I've got one question myself. I mean, I've got a lot of clients, and they're all in completely different income brackets. Who is your average investor?
So funny story. We've spent a lot of money with advertising firms to kind of come, when we were launching this fund, to come up with who is your target market. And quite frankly, it kind of cuts across economic or socioeconomic, demographic lines. It's not I can't kind of ring fence them as a husband and wife with 2.3 kids and a picket fence. And it's got nothing to do with that, actually. The ideal client is patient, understands that they want their investment to be tied to the value, directly tied to the value of the asset. And that's kind of the disconnect in public real estate investing versus private real estate investing. Because you could have a great apartment building in Cap REIT, which is an excellent public REIT, it's huge. But when the stock market goes down, the value of your investment isn't reflected by the value of Cap REIT's buildings, because their buildings are still collecting rent, they're still paying their expenses, they're still paying the mortgage, but you as the investor aren't seeing that because pandemic, because of profit taking, because of a tweet from a president, whatever. There's that disconnect. So our ideal client is someone obviously who wants exposure to real estate, understands that it's going to help them. But it's someone that is looking for alternatives. I'm going to use my kids' rabbit ears again. So, alternatives to stocks, bonds, mutual funds, ETFs. It's someone that knows they need to do something different to add uncorrelated returns, returns that don't move with the stock market and have stability and predictability. I always use the Moneyball analogy with real estate, especially with apartments. You're not going to hit a grand slam with apartments. If you do, there's probably a lot of risk associated with it. And if you're okay with that risk, by all means, go and do it. But apartments are get on base. Get on base, get on base every single time, month over month, year after year. That's how you will do well in apartments.
No, it makes sense. I'd rather be the passive investor than try to hit the home run.
You don't want to deal with broken toilets at 4 a.m., Dan?
Nah, I gave that up.
You don't want to dirty that blazer. Like, I got it.
I gave that up 20 years ago. Now on the screen, I see we've got we got Simeon here.
I thought I was the only handsome bald guy that was going to be on screen today.
Guess again, pal. Guess again.
So everybody knows
doing,
that I've had Simos on my investment series many times, brings a wealth of information to the table. Hey, nice to see you, man.
Oh, looks like he's got a janky internet connection.
Yeah. Yeah. You there?
I do. Give me 1 second. It's better in a few places.
Yeah.
I am.
So, Cliff, what about you? Is there anything else, or you've done a nice, well-rounded discussion on the investment side? I understand you're coming a little better now.
This is a little bit better, guys.
A little bit.
Okay, talk to me.
No, he's away. There we go. I was done. I think I've bored everybody to tears. So, but happy to open the floor to any questions that people might have about apartments or real estate or anything. Where I get my hair cut, I'm good to go.
Give me.
No, to be honest, I think I had several questions which you answered already. Is that Simos?
Might be.
Getting a little bit of feedback.
Okay, so I think,
Okay, well, okay, I'm not sure what that is, but I just want to finish off introducing Shen Walji, who's on the screen now.
seems to be there's some feedback over there. Hi,
All right.
everybody. I am one of Dan's agents on his team, and I really want to thank everyone for showing up today, because part of the investment series is to bring you options, right? We are creating this investment vertical for those clients of ours that want to be in the know. So we've created the Insiders Club. And part of the Insiders Club is to get firsthand knowledge with accessed information from folks like Equiton. And our collaboration with RESP has spanned the limits to take you into properties that are available for multi-residential and our commercial arm. We have plenty of coming soon opportunities. We've got vacant lots where we know a lot of people wish to build custom from the ground up. And of course, we've got pre-construction allocated units throughout the GTA. REC and their reach and their partnerships and collaboration with some of the bigger developers around the GTA have given us at the Dan Cooper Group the opportunity to provide our select clients with some very firsthand opportunity to buy into allocated units. So the next project that I wanted to let everyone know, okay, and this is just my little tidbit of information that I will leave off with. And of course, Simeon, this is your project, so you're gonna be able to talk to it till the cows come home. But it's the new QA investment in the heart of Leslieville, right? Just at the corner.
Sorry, can you guys hear me now? I should be much better.
Yes, we can.
Yes, perfect. Okay, go on. Sorry about that.
Yeah. Just very quickly, QA, which stands for Queen and Ashbridge, is just north of Ashbridge's Bay, right at Queen and Coxwell. If anyone knows this area, it's just on the downtown east portion of Toronto. Leslieville is a real nice, trendy part of the city. It's a burgeoning region with lots of new flair and cafes, restaurants, a lot of commercial buildings going up. It is the place to be. So QA is the next project that we are touting with the help of REC. I'd like to let everyone know that this particular building is 17 stories high, 366 residential units, Completion is 2023. It's going to be a mix of 1 bedrooms, 2 bedrooms, 3 bedrooms, and they're quite generous in size, right? Anywhere from 500 square feet all the way up to 1843 square feet. So lots of opportunity here to make a good return. We've helped REC with selling out on their recent projects in Oakville at the Dun West, which was Dundas and Trafalgar. We also helped put our clients into the new building coming up in Cooksville, which is at Huron, Ontario and Dundas, called Artform. And 181 East was a major success up in the Willowdale community. So this is the next big one, guys. Please pay special attention to this. Again, if you want more insider knowledge on prices, floor plans, everything that you need to know about the building itself, go to hello@dancooper.com. The project is, again, QA, stands for Queen and Ashbridge. The developer is RioCan and Context. So worksheets are due at, well, in the next 5 days. September 22nd is when the worksheets are due. So please, if you have any interest, give us a shout and we'll get back to you with more information.
For sure. And thank you so much, Jen, for the wonderful intro. It's much appreciated. It's very kind words. Dan, nice to see you again. Sorry, the internet's a little choppy. I'm just north of the city. I had a commercial inspection tonight, and I'm actually at the part of the building that I'm inspecting. It's actually an old billiards hall. So their internet was spotty, so I'm actually tethering off my phone. But I definitely wanted to make it here tonight to have this quick conversation with your audience, and hopefully many of them can once again participate in some of the offerings that we're able to bring to them.
Very nice.
Do you, and again, like, you have such a vast audience because of your presence in that Oakville and Burlington market. Where do you want me to speak a little bit about the technique of pre-construction as an asset class, or do you want to speak a little bit more about this specific opportunity? Because there's a few really good opportunities right now.
I want to hear about the opportunities.
Yeah.
So I mean, the people listening want to hear about the opportunities.
For sure. So as far as QA is concerned, it is RioCan and Context, two of our country's biggest developers. The minute that we partner with people like RioCan in selling product to investors, that makes the investor be able to rest easy that the project's not going to get canceled because of nonsense such as them not being able to get financing, them not having a strong enough resume to convince a bank to back their project, etc. They don't go to market before zoning is complete. So this is a zoned, Tarion approved project that is launching to the platinum. There's literally a dozen of us in the entire city of Toronto that have access to specific product at a certain time, and the incentives that we negotiate for our clients, because we have such deep relationships with RioCan, with Context, with the Lanteras, the Alteras, the biggest developers who depend on the select broker community to be able to get to that 50% sales threshold. So we do get special incentives that in 3 months will not exist. Every week that passes, prices go up and incentives disappear. It's that simple, because they don't need to give those incentives at that point. So the reason pre-construction makes sense, and the only way you can mitigate the risk of investing into the future, because you don't own a property. When you buy a pre-construction project, all you're buying is a contract. This contract is a promise to build you your piece of real estate in the sky and or on a lot, but you're investing in a city's future, in the city's economy 2, 3, 4 years in advance. When an investor is willing to risk their down payment and put it down in an asset that performs over time, they expect a specific return, and they expect and put themselves subject to specific risk. When you invest with developers who have proven track records, it's no different than why Cliff was on this screen a few minutes ago. There's 100 million different funds you can invest in. But I can assure you, if your audience takes the time to Google Mr. Fraser's company, to Google the performance of Equiton over the last 5 or 10 years, they're going to see something very satisfying. They're going to feel very secure and very safe, because it's not that hard to find somebody who's invested with Equiton, just like it's not hard to find somebody who's invested in a building built by Tridel, or Minto Communities, or Lanterra, or H&R, or RioCan, or Smart Centers, the names that you see every single day, day in, day out. If I'm looking to invest my RSPs, I go to Equiton, and I don't just talk about it. I am in Equiton. I am in their balanced fund. I have my RSPs at Equiton, and the reason I invest with Equiton is not because Cliff Fraser is so amazingly handsome, or maybe it is Cliff.
Yeah, it's just that's our secret, man. That was our secret. You're letting the bromance out. Now everybody knows.
No, it's proven track record. So due diligence is king. So what we do for our clients, what we've built our bones on, our reputation to uphold. You can Google my name all day long. I'm not that hard to find. But what the bottom line is, when we collaborate with Dan Cooper, with his audience, the whole point of this is to extend our reach into an organization that has clients that are real, that are at a stage of their lives where they're looking for investments that make sense. And that's the whole point of this exercise, is to grow and scale our businesses while everybody is having fun and everybody's making money, and nobody's going to bed worried, will my money be there in the morning? They don't have to depend on their stocks when the next second wave comes and another 40% is going to be wiped off people's hard-earned pensions, because that just doesn't happen in real estate in that way. You don't wake up tomorrow morning and half your house is gone, because it doesn't work that way. When you invest in apartment buildings, the pandemic is only going to drive the cap rates lower and the values higher. Why? Because it's a sought after refuge for the smart money on this planet. And when I mean about smart money, I'm talking about every single pension fund. Take a look at what Oxford, what any of the pension funds, take a look at what their portfolios are made out of. I can assure you they're not made of stocks and bonds. They're made out of apartment buildings and commercial holdings in the biggest centers in the country. The builders that build those commercial and retail plazas, those commercial buildings, those purpose-built rentals, are the people that we partner with. So RioCan, if people in Oakville and Burlington don't know what RioCan is, they haven't left their house, because almost 1 in 2 plazas in Oakville and Burlington are owned by and managed by RioCan. Like literally, because I lived in Oakville for 7 years. I drove by 9 RioCan centers in a 4-kilometer stretch. Yeah, so our friends at RioCan are building QA, Queen and Ashbridges. Leslieville, that part of Toronto, is slated for it has been subject to immense growth in the last decade. I personally own a number of condominiums in the River City sector, which is just on the west side of Leslieville, in the last address of Toronto before you go into East York. So there's Toronto is York, then East York. It's all Toronto, but like I'm on the west side of the Don Valley. The east side of the Don Valley is where the Unilever site is. That Unilever site is going to change the face of our city. There's going to be a second downtown there. So the entire transit expansion, millions of square feet of office and retail, and condos. We already have well over 30 condominiums built, with well over probably 60 to 80 towers coming in the next decade. This specific one is east of Leslieville, right at Queen and Ashbridges, on what a lot of people are referring to, like, so it's all green space in front of it. So there's going to be some tremendous water views. There's going to be some tremendous views to the west of the cityscape. And of course, to the north and the east, you have all of East York, which is one big green garden. And this is not a high-rise, get-lost site. This is going to attract a lot of end users and long-term tenants, which is precisely what you want in a nice and stabilized building. This is going to be fantastic for investors, because we have negotiated 24 units with a very attractive deposit structure. When you're investing pre-construction, half the battle is how much you're investing and when. it's easy to say to someone they're putting down 20% because it makes the conversation easy, but it's not true. So between now and 2023 or 2024, when this building will take occupancy, there's going to be phased in payments. 5% will be done in the first 30 days. 5% will be done in 2021. Another 5% is going to be done in 2022. If you take the aggregate as to how much you invest in each year versus the appreciation in the city of Toronto, you're not, to say that you're getting a free condo, I don't want to make it sound like a gimmick, but you're going to make more. That 5% that you put down, that 25 grand, is going to start appreciating the entire value of the condominium today. And this isn't maybe pie in the sky dreams. I can line up 20 people tomorrow morning that have done it. I have done it. You, I know as a fact, have done it now, because I know what's in your portfolio. We've had many delicious Scotch beverages talking about our real estate business on many occasions. So it's very easy to not have to sell this to people. Rather, I would like people to put up their hand. And if they feel that this is something that interests them, if an equity play, a passive equity play is right for them, to invest in it. It is not anything like the Equiton play. It is not anything like an income property that you close on tomorrow play. They're different. And if you think that this may be right for you, they should book the consult with your office, and it's very easy to do. I can pipe in and make myself available anytime, as you very well know.
So I got questions are coming in. I've got one here from Mike, and
sure.
Basically, I have 80,000 in an RRSP just sitting in bank recommended funds. How can I use that money to invest with you? Who wants it?
I think that question is for Cliff Fraser. It's an RRSP.
Yeah, so absolutely. So, you know, one of the things that need to happen, I don't know, Mike, if you're on at the beginning, is what we do when investors are interested in working with us is we have to take a look at your full financial profile. So we will ask some probing, awkward questions, but it's important for us to do that. We're required to do that to understand exactly what is suitable for you. So, you know, some investments will be happy to take all of it, but what we have to do is look and see if that is appropriate based on your financial position. So absolutely, you can reach out to us and we can take a look at that a little bit further to see, you know, if that's appropriate. But we can certainly put those funds to, you know, some of those funds, if not all those funds, to use, depending on your position.
Okay. Let's see. I've got one from Omer. Sorry, I logged in late. Can we speak a little bit about returns quantitatively per month of cash flow?
Yeah. So depending on the type of which fund, whether it's the apartment fund or the balance fund, they both have slightly different cash flows. Actually, no, that's incorrect. Both of them are paying the same rate of cash flow right now. So on the apartment fund, it's 6% annually. We pay that monthly. And then on the balanced fund, it's also 6% annually. But what the big difference is the appreciation of the shares over time. So I think trailing 12 months for the apartment fund right now, total return, so cash flow as well as the share price going up over time, is around 9.5%, 10%. And we're a little bit less than that on the balanced fund right now. That's because we're still working at deploying some of that money into some new assets, which we're hoping we're going to be able to announce very soon.
And I would like to actually ask Cliff, I don't know if you covered it earlier because I wasn't able to catch the actual beginning of your conversation with John. And because I'm personally a huge fan of the Equiton funds and the model.
Thank you.
I hope people understand how much of a hybrid that fund really is. So when somebody's getting a 6% yield, a 6% yield on a real estate fund that is actually appreciating over time, I actually would beg our audience to just take some time and Google what that asset class has done in Ontario, in the GTA specifically, in Northern Ontario specifically. Really Google it. And because if you were to have a conversation with Cliff later and say, where are your properties? Because I did some research. Where are the properties that we're investing in? And Clifford, to answer, they're here, here, and here. The appreciation year over year, forget the value add of you guys modernizing them.
Right.
I'm talking about just as an acceptable cap rate alone, to have an RSP, which typically performs between 2 and 5% for most people, paying you 6% annually income, plus have the appreciation, and you've done nothing but pick your nose on a Saturday afternoon, my friends, take a serious look at what your investment goals are. The Equiton fund, for me, is probably one of the best investments you can make in the market passively. Passive investments we're talking about, with an absolute proven track record, and their head offices are literally 2 minutes from everyone's on this webcast homes. They're on South Service Road in Burlington. So these aren't people pie in the sky in a big tower downtown that you can't find or speak to or understand. These are people who speak your language. So
And I'll give you the addresses of the buildings. We can go and look. So there's nothing to hide here. There's nothing to hide.
No, I just wanted to make sure that people understand like what a true hybrid it is. And you're investing your back end wealth. You're investing your RSPs into something that's paying you upfront and on the back end. It's pretty rare to have a fund operate that way and for so long consistently. So kudos to your whole team. I'm just a big fan.
Thanks.
That's why my money's there.
I appreciate that. Thank you.
Cheers.
Well, guys, that was a pretty good discussion. I think we're going to try and close this down just because it's been a good hour of conversation. Simos, I'm glad you had a chance to join in and say hi. And special thanks to Cliff for a brilliant discussion and a very elaborate discussion on your company. So a lot of opportunity out there for everybody. The market is ripe for this kind of investing. Rates are right, the interest is there, and I've got some very smart people I've aligned myself with. So it's pretty easy to do. So basically, as we mentioned earlier, you can just go to my website or just hello@dancooper.com, leave your questions, and we will be back at you. So again, thanks everybody, appreciate it. And we'll reconvene in a month from now on another topic.
Thanks,
I would like to say good night to all your audience, my friend. I hope everybody's kids are back in school and you have a moment to breathe safely. Everybody be good. Dan, be good. I hope to see you next week, pal. We should be having lunch, I think, next Thursday.
Love that. Sounds great.
Thanks, gentlemen.
Thanks for having us, man.
Have a great night. Thank you. Bye-bye.
Bye, guys.